Greetings, everyone. Welcome to the DC Bar Pro Bono Center's two-part webinar series, Tax Considerations for Small Businesses, a Legal Perspective, brought to you in partnership with Dechert and DC's Office of Tax and Revenue. I'm Daryl Maxwell, a director at the DC Bar Pro Bono Center. Before we get started with the webinar, I'd like to thank a few people first. First on that list is Lauren Paley, our Associate Manager at the Pro Bono Center, for helping with all of our logistics and making this sort of a well-oiled machine today. Next, a huge thank you to our friends at Dechert, presenters who you will hear from in a minute, Daniel Ng and Gwen Park, who stepped in to develop and provide all this really helpful and fantastic information for small businesses. I want to thank them, as well as Mike Roofcar, who you will hear in our next webinar. Lastly, I'd like to thank the DC Office of Tax and Revenue for co-sponsoring the program. You'll be hearing from a representative from OTR in our next program on February 24th. Let me set some of the ground rules for today's webinar. First, this webinar will be recorded. Additionally, you have access to the slides in your dashboard. There is a section for handouts. You'll be able to receive a PDF of the handouts there and follow along. For any questions that you might have, there is also a question box in the dashboard where you can share those questions. We will be taking questions in about the middle of the webinar and then towards the end. And so, again, we want to make this interactive, so I will be trying to sort of keep track of all those questions that you have coming in. Small businesses are often confused by the tax implications of choosing a business entity, but also sort of what happens during sort of the course of their day-to-day business. Both Daniel and Gwen are going to help us understand some of those implications and try to demystify some of those issues. Daniel, I know you're starting us off. I'm going to turn it over to you.
Thank you, Daryl. Thank you, Daryl and Lauren, and everyone at the DC Bar Pro Bono Center for making today's presentation possible. Hi, everyone. Happy Wednesday. Welcome to part one of Tax Basics for Businesses. Apologies, you're not able to see me today. I couldn't figure out how to disable the cat filter from my webcam. My name is Daniel Ng. I am a tax associate at Dechert. I am joined today by two of my colleagues, Mike Roofcar, a tax partner at Dechert, and Gwen Park, a tax associate at Dechert. What we are hoping you are able to take away from today's presentation is having a basic understanding of how the tax system works and how it applies to your business. So the focus of today's presentation is really on the basics of the U.S. federal income tax system and how the choice of legal entity affects the taxation of your business. So topics we will cover, and apologies for being extra stereotypical and adding a asterisk and footnote on the very first line of the presentation. But we have to say that the U.S. tax rules are very complex. So this presentation is limited to U.S. businesses operating in the U.S. and whose owners are U.S. persons. And secondly, that we are only covering U.S. federal income taxes. But as you know, there are other taxes such as state and local tax matters, which are often significant in terms of numbers, but are not covered in today's presentation. So we will start off with some tax basics, giving you some groundwork on understanding how the U.S. tax system works and how this drives choosing the form of your business and the taxation results of the business. Then we will get into a little bit about the magic of what is known as check-the-box elections, how entities can be treated as something different for tax purposes. Then we'll get into a broad which entity is right for your business. And then we'll end off with a brief word on employee benefits and a life cycle of a business. And there will be questions and answers at the end, and also a brief session during the middle. Okay, so on tax basics, first of all, the US is known as a double taxation system. So what this means is a source of income is generally taxed twice. So if you think of it as you as a business owner owning a corporation that does business, the profits of the business are really taxed twice. So the first layer of tax is paid by the corporation. The corporation pays corporate income tax on its profits, and then the corporation will have some leftover cash. So if the corporation then decides to distribute this cash to the owner, it is taxed again at the hands of the owner. So therefore, two layers of tax, or double taxation. So when you are conducting your business, you may decide to retain some profits to fund it back into the business. These profits will generally be able to be deducted, lowering your taxable income. However, if you want to distribute the cash out eventually, you will pay tax at both the corporate level and then again when you receive the cash. One thing to say here is that the undistributed profits will generally enhance the value of the business. Later on, when you sell the business, you will be taxed on the gain on the sale of the business. And losses for tax purposes in a corporate vehicle remain at the level of the corporation and do not flow up to the owners. However, if a corporation has a loss in 1 year and does not have any taxable income, this loss can be carried forward and to a certain extent carried back, subject to certain limitations in taxable years where the corporation actually does have taxable income and tax to pay to the IRS. So corporate tax rates and individual tax rates on capital gains and dividends. The first thing to know is that the US tax system is generally a progressive tax system. What this means is that a person that makes more income is subject to a higher percentage of tax than somebody who makes less income. And prior to the Tax Cuts and Jobs Act, which was enacted in late 2017, this also applied to corporate tax rates. So with tax reform, however, the corporate tax rate became a flat tax rate of 21%. I believe prior to that, it scaled up to a maximum of 35%. The individual tax rates, however, remain progressive. And what we are displaying here is the tax rates on capital gains and dividends. So if you are a shareholder of a corporation and you receive a dividend distribution from that corporation, you are subject to these tax rates displayed here on dividends received. So this starts at 0% and maxes out at 20%. However, there's an additional tax which is not reflected in this table, which is the 3.8% net investment income tax, which is a tax for high income taxpayers, which is added on to this 0, 15, 20%. I believe it kicks in at around 15% at a different scale, and it's generally geared towards any passive income that the individual receives during the tax year. And here is the table on the individual tax rates on taxable income. As you know, it scales up from 10% and maxes out at 37%. So if you are an individual and you are getting a salary from your business, you will be taxed at the rates below. And note that the 37% is a much higher number than the maximum 20% that you would be taxed at if you had received a dividend from the company. So the two main entities, or sort of the two main tax regimes for businesses is corporate taxes versus, or taxation on corporations versus taxation on pass-through entities. So we think of a corporation as, for tax purposes, is anything that ends in incorporation or has in the name corporation. So if you registered a company under, for example, Delaware State, and it's a Delaware Inc., that would be a corporation for tax purposes. However, there is also pass-through entities, and these pass-through entities can be such things as a sole proprietorship, even if there isn't a legal entity, sorry, an LLC that is treated as a pass-through entity or a partnership. And these entities are generally not taxed at the entity level. So this may be one point of interest, as generally there isn't a double layer of taxation if you are receiving distributions or your pro rata share of income generated through a pass-through entity. So as I just said, the profits of a pass-through entity is one level of tax. So the entity itself is not taxed. However, the profits pass through to the owners, and the owners would report the income or their pro rata share of their income from the pass-through entity on their personal federal income tax return. There is no additional tax to owners on distributions from the business. So that 0 to 20% doesn't apply. It's the 0 through 37% individual tax rates would apply. And the owners are taxed on the profits, whether or not it is distributed. So every year that the business makes money, there is no concept of returned earnings. Really, you are taxed as if you own the pro rata share of the business directly. And then the tax basis in the business is increased by undistributed profit and reduced when distributions are made. And losses. So losses are different than a corporation. So losses in a pass-through entity flow up directly to the owners in that taxable year. These losses may be able to be used by the owner to offset his or her income from other sources. And this generally applies if the owner is actively involved in the small business. However, there are limitations if you are just generating losses from, let's say, a passive investment in a pass-through entity, and you're not actively involved in the day-to-day. For example, if you're not what I guess we would consider a worker or employee of the business. However, one thing to say is that while you're able to take these losses currently in the tax year that the business is at a loss, they also reduce your tax basis in the business. So a sale at a future date of the business will or may be subject to a higher amount of gain because your basis in the business has been lowered by taking these losses. With tax reform in 2017 came a provision known as the Qualified Business Income Deduction. This applies to pass-through entities and allows eligible taxpayers to deduct up to 20% of the income earned through a pass-through entity, subject to certain limitations. So I believe what they were thinking of when they enacted this provision was that really this is aimed to businesses that are providing goods and certain services to consumers. So there are two main limitations that to the QBI deduction. The first is an income limitation, and that's measured at the owner's income levels, and then the type of business operated by the pass-through entities. So the tax rules go in and define what is a specified service trade or business, and these specified service trade or businesses are subject to a different limitation. So it's generally any trade or business where the principal asset is the reputation or skill of one or more of its employees or owners. So there's a harsher or a lower QBI deduction allowed for businesses that are SSTBs. So for example, law firms, medical practices, consulting firms, accountants, financial advisors, investment managers, performers, athletics, performing arts and consulting. These would generally not be not avail themselves to the higher QBI deduction, which goes away after you meet a certain income threshold. Okay, sorry about that. Back to the QBI deductions. So here are the income limitations and how they work. If your business is a specified service trade or business, and again, that's healthcare, law, accounting, actuarial science, and if it's not a specified service trade or business. So if your business is a specified service trade or business, you are still allowed a full 20% QBI deduction if your total taxable income is less than either $157,500 for a single filer or $315,000 for a married couple that files jointly. This tapers off if your taxable income is above those limits and goes away completely if your taxable income is greater than $207,500 for a single filer or $415,000 for a married couple filing jointly. Compare this to if your business is not an SSTB. If you are below the $207,500 threshold for a single filer and $415,000 for a married couple filing jointly, you avail yourself to the full 20% QBI deduction on taxable income from a pass-through. However, if you are above those thresholds, there is a different test. The QBI deduction is limited to the greater of 50% of the W-2 wages paid out in the business or the salaries paid to the employees of the business, or 25% of the share of W-2 wages, again, salaries paid out to employees paid out in the business, plus 2.5% of any qualified property that the business owns. Having said all that, we thought a numerical example would be the best way to present the two different tax results from having either a corporation or a pass-through. So in this example, we have a business earning an annual profit of $300,000 after expenses, but before tax deductions. And the owner takes a salary of half of that, of $150,000. And we assume also that the owner will distribute the rest of the money left over after it takes its salary. And the owner is married, filing a joint return, and the owner and spouse have no other income or deductions for that taxable year. And note again that this example does not include any state and local tax. So first, the corporation. And so the corporation, the first line in blue shows the gross profits of $300,000. And the yellow box, salary of $150,000, this would be a deduction for tax purposes. And the employer who is responsible for the employer's half of the employment taxes, which are known as FICA, 7.65%, which is made up of 6.2% of Social Security tax and a 1.45% Medicare tax. So the employer pays this for its employee. So the employer would pay $11,029. So the taxable income left over from that $300 minus the salary minus the employer's employment tax liability is $139,000. Then the corporation, the first layer of tax, would pay corporate tax at a rate of 21%, which is approximately $29,000, and then the net income of the corporation would be $109,787. So what does the corporation do? The corporation then distributes the money to the owner. So the corporation then makes a gross dividend in the amount of the $109,787 of cash it has to the owner, and then the owner is taxed on this dividend at 15%. So if you recall that first chart up with dividend tax rates, which ranged from 0 to 20%, this one would be taxed at 15%. So the net dividend received by the owner of the company would be $93,319. In addition, though, the owner also receives a gross salary from the corporation. So they receive the $150,000, and then the individual pays its individual income tax on the salary, which is up to 22% at this level, and it pays approximately $24,000. And then the employee pays its share of the employee employment taxes, which is just the half, another half of what the employer paid, or sorry, it's in total it is it's the same amount that the employer paid, but the employee pays half and the employer pays half. So the employee is left with a net salary of $114,000. So in total, the cash received at the end of the day by the owner / employee of this, let's say, wholly owned company, they get their money from their dividend, which is $93,000, and the money from their salary, which is about $114,000, for a total of $207,000, which means the effective tax rate on this income is approximately 31%. So both the corporation and the employee together pay approximately $93,000 in tax. Okay, and compare this to a pass-through entity. So in a pass-through entity, we start out the same. We have $300,000 of gross profits. However, we're assuming here that this business is not a specified service trader business and is eligible for a full QBI deduction of 20%. So we're taking off $60,000 from the gross profits to determine taxable income amount. And similar to how a corporation works, if you are earning salary from a pass-through entity, there's also employment taxes which are due. However, the owner / employee of a pass-through entity is responsible for the full 15.3% of employment taxes that an employer would typically pay half of if owned through a corporation. So here, however, though, an employee is still eligible to take a deduction for as if the employer paid half of the employment taxes. So here we're taking a 7.65% deduction. So the taxable income for tax purposes is $227,000. And just to note that these yellow line items are not actual payments out, they're just reflecting deductions available for tax purposes. So really, if you're making $300,000 in a pass-through entity, in this specific example, the taxable income that is subject to tax by the IRS is $227,666. Okay, and then so your taxable income is $227,666, and then as an owner of a pass-through entity, your taxable income is taxed at the individual tax rates. So that is a tax which is up to 24% because you are in a higher bracket than you were in the corporate example. And you are also subject to the full 15.3% of self-employment tax, as stated earlier. So that's 24,667, which is a little bit higher than in the previous example. So your taxable income here is that should say your total tax here is $67,349. And then your total cash received at the end of the day from that $300,000 after taking away the $67,349 of taxes you paid is $232,000. So the effective tax rate here is lower. As you can see, you paid approximately 67% tax here, or sorry, $67,000 tax here compared to the $93,000 you paid through a corporate example. However, there's probably two things to note here also is that in the first example, you can see that the net dividend amount you received is much lower than the net salary. And both of them are sort of keyed off this $150,000. So if you are making $300,000, you are paying out $150,000 in salary, and you imagine the other $150,000 would come out as dividend. So I guess the question is, why would you not just take a higher salary and not pay a dividend? And yes, that is true in this specific example. However, to note is that the tax rates for dividends max out at 20%, whereas the tax rate on your personal income tax can max out at 37%. So let's say these numbers were double what they are. Perhaps it makes sense to still pay a dividend because maybe that number is greater than the number you would get from your salary. But at the end of the day, this is just a simple comparison between a corporation and a pass-through entity. And note that pass-through entities generally, since they are only subject to one layer of taxation, are generally more tax efficient than a corporate entity. Okay, so let's touch briefly on tax-exempt entities, aka 501c organizations. So I would like you all to note that an enterprise can be tax-exempt if it meets certain substantive and procedure requirements determined under the code. For example, one of them is to be organized and operated solely for charitable, religious, or educational purposes. And you're required to make certain filings to recognize a tax-exempt status. So generally, you would apply to the IRS for tax-exempt status, and they would grant it to you if you fit within these certain constraints. So what that means is that a tax-exempt entity is not subject to the corporate layer of tax on its income. However, tax law places certain constraints on these entities so that you cannot distribute profits outside of the tax-exempt entity, and the salaries must be reasonable as set by guidelines in the code. So in addition to this, though, there are benefits for the tax-exempt entities as they are able to receive donations from the public, and these donations are tax deductible to the donor, As you may know, these are generally 501c3 organizations, and we think of them as religious, educational, charitable, scientific. However, there are many more tax-exempt entities under the code. I believe there's like social and recreational clubs, business leagues, etc. So we just wanted to touch on this briefly in this presentation. Depending on your type of business, this might be something to consider. It's a great tax result at the end of the day. However, you need to fit within the definition of a tax-exempt entity. So drivers in choosing your form of business. So as myself and Gwen will probably tell you that we think tax is the most important thing in driving the form of your business. However, we understand that tax is only one consideration out of many. So first of all, the tax consideration is the tax on your profits and the eventual gain on sale. However, the type of legal entity you form also determines liability for the owner. So having one entity over another may limit the amount of liability for an owner. Another factor is the tax treatment of employee benefits for owners and employees of the business, and that is different among the different types of business entities. The ability to raise capital, as Gwen will speak to later on, the different forms of entities may be more palatable to investors, just depending on what they're used to or what they're used to seeing. In addition, there are governance and control issues, other legal issues, and then the ease and flexibility of an eventual exit of the entity. There are certain restrictions on types of entities. Sorry, not types of restrictions. There are certain types of entities that are more commonly used in acquisition structures than others. And then not the last, but another thing to think about is the organization, compliance, and maintenance costs. So maybe forming an LLC might be very easy. Maybe filing a corporation might be harder, and there may be different costs between the two of them. The magic of what is known as check the box selection. So before going into the details of the different types of entities, we wanted to note that there is something known as the check the box rules under the tax code. What this really means is that if you form, let's say, an LLC, a Delaware LLC, you would probably typically think, oh, limited liability company that may be a taxed as a corporation for U.S. tax purposes and subject to a double taxation. However, these check the box rules state that an entity like an LLC is generally a pass-through entity once it's set up. So it would be taxed as if it's a partnership, or it's taxed as a disregarded entity if it's held by one person. And what the check the box rules allow is certain entities, as long as they are not corporations by state law rules. So if you think something that has an Inc. in the name or Corp in the name, they are eligible entities to make check the box elections. So they can make an election to be treated as a pass-through entity or treated as a corporation just for U.S. tax purposes. There are also certain per se corporations where you are not eligible to make this election. I believe like banking entities and insurance entities, there are some restrictions on being able to be taxed as a pass-through entity, and they are generally corporate entities. So corporations, Inc., Corps, generally not allowed to make a check-the-box election. However, you can elect as an S-Corporation, which is a pass-through entity, but subject to certain ownership rules and I believe stock rules, which Gwen will get into later. So again, an LLC or an LP with more than one owner by default is a pass-through entity. However, you can file this form 8832 either initially when you form the entity or down the line to be treated as a corporation. And a single owner LLC, by default, if it does not make this Form 8832 election, it is treated as a disregarded entity. So it is a pass-through entity, and it is kind of as if the IRS does not see that entity as existing for tax purposes. So if you own a business, wholly own a business through an LLC, and you do not make a check the box election, it's as if you are earning the income, profits, losses of the business directly. So there may be at least some compliance, tax compliance costs that might be saved in addition to tax efficiency by only having one layer of tax. So before I turn over to my colleague Gwen, I think we are going to open it up to questions on the material covered so far.
So we do have a couple of questions, and one of them, there are a couple of the questions I think we're going to get to in the second section, so I'll hold those. But this question, one person asked, do food businesses qualify for the QBI deduction?
And I guess to be more specific on food businesses, are we talking about restaurants? Or are we talking about some other type of food businesses? But I think more generally, if we're talking about a restaurant or a business that sells at the end of the day a good to a consumer, it would generally not be one of the specified service trades or businesses.
Okay, I didn't think so. And then another sort of more practical question that I was asked here, and I've heard a few times, why would a business choose to or elect to be treated as a corporation? You know, just certainly looking at your example earlier, but also more broadly, I would love a little clarity for our listeners. Why somebody would choose to elect to be taxed on the corporate level.
I think Gwen will get into this more specifically later, but there may be some tax efficiency reasons for being in corporate form rather than a pass-through entity. For example, if for example the owners are already subject to a high income tax rate and they want to defer income to a later date, I guess another answer would be if there are lots of losses in the corporation, you can carry them over to years where you have taxable income. Whereas if the entity is a pass-through entity, it's really just like a year-by-year determination of what's happening in the business. There's no carry forward, carry back of these losses.
Okay, and then I've got one more, but I have a feeling you're going to tell me that Gwen is probably going to handle this. But one person asks, if an LLC is entering into a partnership with other LLCs or pass-through entities, are there any particular tax implications for that type of collaboration? I know that might be a little fact specific, but I figured I'd ask anyway.
I guess it would. The main driver would be the entity classification of each of those LLCs, assuming they're all default and are pass-through entities. Let's say the owner owns their own LLC and is owning their share of the, let's say, partnership LLCs with other investors. The LLC that the owner wholly owns is disregarded for tax purposes. So it would be as if they are owning an interest in the investment LLC directly. However, I believe this is mainly done for non-tax purposes. It's like the other legal drivers that are driving this owning through an LLC rather than just owning directly to the investment LLC.
Thank you very much. And so now I think you said we're going to go over to Gwen, so I'm going to turn the controls over to him.
Which type of entity form? I think that was one of the questions that was asked by the audience, was which entity form is right for your business. And there are different types of entities, and mainly in this presentation we're going to talk about sole proprietorship, general partnership, limited partnership, limited liability company, corporation, and S corporation. So we're going to go over each of the entity form and their tax implication, as well as advantages of using the entity type and disadvantages. So sole proprietorship is an unincorporated business owned and run by an individual with no legal distinction between the business and the owner. So it is treated for tax purposes as if the individual is entitled to all the profits, and the downside of it is that that individual is responsible for the debts, losses, and liabilities of the business, and unless otherwise modified by contract. For example, if you're entering into the sole proprietorship, as a sole proprietorship, you're entering into a non-recourse debt, then the owner would not be personally liable for that debt. Otherwise, the owner would be treated as if it owns the assets and is entitled to all the profits and losses. And so this status applies to a business if there's a sole owner and no action is taken to form an entity. So I'm going to just talk about some of the other entity types, but for purposes of this sole proprietorship, if you as an owner is not taking any action to form an entity, it is by default treated as a sole proprietorship. And a sole proprietorship may exist even if the business is conducted under a trade name. Next slide. The business is not taxed separately from its owner, as said before. So generally what happens is that the owner reports the business income on its Schedule C of its personal tax return, Form 1040, and the owner is taxed on profits of the business, whether or not the profits remain in the business. So even if the business made profits and the money sits in its bank account, the owner would still be taxed. But the other side of this coin is that the owner can help himself or help herself to cash in the business without an extra tax at any time. The advantages of sole proprietorship is that it's generally cheaper than other forms because you're not setting up or forming an entity. It's generally low cost to set up and maintain. Some owners choose to register a trade name to create a commercial identity for the business, but as said earlier, sole proprietorship exists whether or not the business is conducted under a trade name. The advantages are that the tax advantages of pass-through status that Daniel discussed earlier in slides 6 and 10, in case you are wondering. So there's no entity level tax, and there's no tax on distribution from the entity to its owner. Okay, so what are disadvantages of using sole proprietorship? And it is something that I mentioned earlier. It's unlimited personal liability. So what sole owners often do is that they put their business into an LLC, which Daniel said is disregarded under check the box rules. So for tax purposes, it's as if the entity doesn't exist and ends up being taxed exactly the same way as a sole proprietorship is taxed, but with the advantage of limited liability. So if you're planning on operating a business that may result in unforeseen and unacceptable exposure for contract or tort liability, then you might want to consider putting that business into an LLC. That way, the owner is protected from potential liability. But having said that, in case of tort liabilities for harm caused to others, the organizational veil may be pierced and the owner may have liability, whether or not the business is in LLC form. So liability insurance is often prudent even when a limited liability vehicle is used. Having talked about sole proprietorship, next type of entity is general partnership. And general partnership is a business with more than one owner called partners. Partners in a general partnership are personally liable for all business liabilities, jointly and severally, and can be sued individually for the actions of another partner. And it is possible that by agreement and under common law, a partner who is tagged for liability to third parties may have a right of contribution from other partners. And so if one partner is subject to liabilities to a third party, then the other partners may be brought in to cover the losses. Partners contribute capital, that means money or property, including intangible assets like know-how, or sweat asset equity, which is often referred to as for services to the partnership, in return for a share of profits and losses in agreed percentages or other sharing arrangements. So the downside, which I'll cover later, but the downside of general partnership is that any partner can bind the business with his or her actions. So you can try to create a governance rules to avoid this among partners, but they tend not to be effective against third parties. So if the business has liabilities against third parties, even if you have governance document that says the other partners will not be liable for the actions of a partner, the other partners would be generally be liable. So how is general partnership taxed? It is taxed as pass-through entities. So the characteristics are described in slide 6 to 10. And a partnership files a Form 1065 annual partnership return and issues K-1 information returns to each partner showing their share of partnership losses, gains, and other tax attributes. And upon receiving this K-1 information, each partner will be reporting their share of partnership losses, gains, and other tax attributes in its personal tax return. So the advantages of using general partnership is that business structure is easier to form and maintain than a corporation, LLC, or limited partnership, and relatively inexpensive to maintain. So there's no need for a legal filing. A partnership can exist through an oral agreement. However, there are hazards of misunderstanding, disputes if partnership details are not reduced to writing. So it is suggested, we would advise that if you're entering into general partnership, it would be prudent to enter into a formal writing and partnership agreement. So some other advantages of using general partnership are that it's flexible on the economics, which includes priorities of payment. So certain partners can get money before other partners, but this comes at the price of needing a written partnership agreement, which can get complicated. Another advantage is that sharing financial commitment can mean that all partners are invested in the entity's success. This does not really relate to tax, but this is something to consider when you're entering into partnership, the benefit of entering into partnership. Other disadvantages are that joint and several liabilities that I discussed before, and that each partner can bind the business and potentially the other partners. And another disadvantage is that partnership agreements generally can be quite complicated, and even simple partnerships tend to end up with fairly elaborate agreements that require certain legal skill to create. And this disadvantage is shared among other multi-owner pass-through entities. Having talked about general partnership, let's go over to limited partnership. So limited partnership is a partnership with at least one general partner and one or more limited partners. So unlike the general partnership, in the limited partnership, limited partners enjoy limited liability, but they cannot be involved in the business. So limited partners would not be permitted to engage in the management of the partnership generally. General partners control and run the business, but they are subject to unlimited liability, so personal liability. Limited partnership status can generally require a state law filing and provisions in a written partnership agreement that spell out the status and role of the general partners and limited partners. So limited partners are taxed just like general partnership with attributes of being a multi-owner pass-through and the fact that the limited partners have limited liabilities. Okay, all right, let's move on to limited liability company. So limited liability company is a hybrid business entity that provides limited liability feature of a corporation with pass-through tax treatment, and it is very flexible in operational and governance sense. And owners here are called members. In the partnership, they are called partners. Here, they are called members. Depending on your state, members may be a single individual or two or more individuals, corporations, or other LLCs. And all owners have limited liability. And similar to limited partnership, limited partners in the limited liability company, limited liability partnership, the owners have limited liability, and they have freedom to choose who is involved in the business and how governance structures work. So it's very flexible as to who can make the decisions in the business. And LLC can be used to create limited liability for a sole proprietorship. As mentioned earlier, as a sole proprietor, you can put your business into an LLC to create a potential protection against liability. And under the check the box rules, the LLC can be disregarded for income tax purposes. So if it's domestic LLC if a single member LLC owned by one owner, it is for tax purposes by default, generally treated as disregarded for income tax purposes. In some cases, there will be a state level tax imposed on the LLC as an entity. I believe New York is one of those states that impose unincorporated taxes on the LLC to the extent that the LLC drives income within the state. So LLCs are taxed as pass-through entities with tax attributes of a partnership or sole proprietorship if there is only one owner. So if the LLC has more than two or more members, then it is treated as a partnership. And if it's solely owned by one owner, then it is considered disregarded for tax purposes. The advantages of the LLC are that it has limited liability for members and flexibility in economics and governance. Pass-through taxation applies unless and until the owners decide to check the LLC into corporate status for tax purposes. The disadvantages of using LLC as entity form are that stale filing is required as an LLC, and limited liability depends on ongoing maintenance of formalities. And the LLC agreement is one of them. An LLC agreement, often called the operating agreement, can be complex depending on the economics and governance arrangement desired by the ownership. And as mentioned earlier, LLC may be subject to state or local entity tax. So I think one of the questions that the audience asked was, why would you check the box to treat the entity as a corporation? And Daniel explained it. So I'll cover that in the corporation section. The corporation is an independent legal entity that is owned by shareholders. Shareholders purchase stock of the corporation with money or other assets, and the corporation uses this money for operational purposes. As many of you know, the corporation is a legal person and is legally liable for its actions, debts, and taxes. Under the check the box rules that Daniel mentioned, a business corporation is per se corporation and sometimes referred to as C-Corp. because it's governed by subchapter C rules of the tax code. And if eligible, a corporation can elect to be an S-Corp, which I'll discuss later, that is treated as a modified form of a pass-through. People say that C-Corps are like lobster traps because it's relatively easy to get into, but potentially difficult and expensive to get out of. To get out of the corporate form, you have to complete liquidation of the entity, which is a taxable event. So a corporation and the owners will be taxed on any appreciation of the business assets and business as a whole. So that's one consideration and choosing an entity form is that if you're a pass-through entity, then it's generally easier to get into the corporate form by checking the box by filing 8832. But if the business starts in a corporate form, it may be costly to become a pass-through business. Corporations are taxed as separate tax-paying entity, described in slides 3 and 4. And the advantages of using corporation are that it offers limited liability for shareholders, and documentation and governance can be more straightforward than partnership agreements and LLC operating agreements. Even though LLC operating agreements and partnership agreements offer more flexibility to the owners. And the other advantages include the ability to raise capital more easily through the sale of its stock to shareholders. And Daniel alluded to this before in answering the question. The corporate tax rates are usually lower than personal income tax rates for high income tax individuals. So potentially 37% income tax versus 21% fixed rate. So other advantages of using corporation include that owners of a corporation pay tax only on dividends received from the corporation, as well as salaries and bonuses to the extent that they're employed by the corporation. So the corporation, in the example, the chart in slides 11, I think, that the corporation pays the employer's share of employment, Social Security, and Obama or Affordable Care Act taxes. As opposed to a partnership where partners who are active in the business are subject to self-employment tax. They pay, in effect, both halves of Social Security and Obamacare tax. So a corporation would be a good entity choice if you're operating in a higher capital industries or you want to attract capital from investors or the public. The other consideration that you might want to think about is corporation. It's easier to attract investment from non-US persons than tax-exempt organizations. Because as a non-US person, if you are making an investment into a partnership as a partner, and if the entity is based in the US and engaged in a US traded business, then it has the potential to cause that non-US person to be subject to US tax and tax filing requirement. So corporation is often used to attract non-US persons. Other advantages for corporation include that corporations are also able to be acquired in exchange for stock in another corporation on a tax-free basis. So tax-free reorganization of a corporation is available, whereas a tax-free acquisition by a business in pass-through forms, so limited partnership and certain LLCs, is sometimes available, but the opportunities for doing so tend to be much more restrictive than the rules governing corporate stock swaps. Then what are the disadvantages of using corporation as entity form? It is mainly that it's subject to double taxation. So the entity is subject to tax when it earns profit, and stockholders are taxed when they receive dividends. The incorporation process can be more involved than the process to start and maintain other entities. And corporations tend not to be as flexible as partnerships or LLCs when complex economic arrangements are desired by the parties. Another thing to consider is that for corporations, qualified small business stock is available. So that means shareholders that sell qualified small business stock can exclude a portion of the gain on the sale from their federal income tax if they have held the QSBS for at least 5 years when it is sold. So if you're a qualified small business and shareholders held the stock for at least 5 years, then a portion of the gain from the sale will be excluded. And the remaining gain is taxed at applicable capital gains rate, potentially up to 20%. Qualified small business stock is defined as stock in a domestic C-Corp that does not have more than $50 million in assets as of the date the stock was issued and immediately after the issuance. So this qualified small, as the name suggests, it's available to certain small businesses. And other requirements are stock must be acquired at its original issuance, not from a secondary market. And the C Corp's assets must be used in the active business conduct of a qualified business. So let's move on to S corporations. So S corporations are corporations that elect S Corp status from the beginning of their existence, and they're treated in many ways as a pass-through. So it's treated as pass-through, so profits and losses flow through to shareholders. And this is, I guess, disadvantage will be that the shareholders will be subject to tax whether or not actual cash is distributed. On the other side, distributions of cash generally are not taxed. And basis adjustments to shares for undistributed profits and losses are similar to the pass-through rules discussed before. So what are disadvantages of using S-Corp? So one disadvantage is that there's restriction on eligibility to make and maintain S-Corp status. So even if you wanted to form an S-Corp or transform your C-Corp into an S-Corp, might not be allowed. Making an S-Corp status is only allowed if it has common stock, which can be voting or non-voting, but preferred stock or other classes of shares are not allowed. So generally, one class of stock is allowed. And the ownership in S-Corp is generally restricted to U.S. individuals, estates, and certain types of trusts. And there is also a requirement that the S-Corp cannot be held more than 100 stockholders. And it is all too easy to lose S-Corp eligibility through pitfall violations of the rules. And another disadvantage is that while partnerships are generally able to distribute assets in kind, meaning non-cash assets, without triggering tax to owners, but in certain circumstances for S-Corp, the owners will generally be taxed on the assets appreciation. This relates to the previous point that S-Corp that was previously a C-Corp, and then the C-Corp elects to become an S-Corp is subject to further adverse and technical rules, which could also apply to an S-Corp that acquires a C-Corp by merger. Because the advantages of pass-through tax status, limited liability, and economic flexibility can be obtained using an LLC, it is generally not advisable to use an S-Corp for the pass-through treatment when other pass-through entity forms are available. So those are the types of entities and how they're taxed, as well as advantages and disadvantages of using each type of entity. So just to cover briefly on employee benefits, a pass-through owner is generally subject to self-employment tax, whereas a corporate employee is generally liable for only 1/2 of the parallel Social Security and Medicare taxes. It was mentioned earlier, So that would be 15.3%. The other half is, well, the whole 100% will be 15.6, and half of that in the case of a corporate employees. And the other half is paid by the employer as a deductible expense. Pass-throughs that are partnerships for tax purposes provide certain tax-favored opportunities for service providers to obtain equity interest. These are often called profits interests that are generally not available to corporate employees. Whereas a typical equity incentive arrangement for corporate employees involving stock options will result in ordinary income treatment, these profits interests receive capital gains treatment, but these are generally subject to the rules in order for the profits interest to benefit from the capital gains rate. And the profits interest alleged loophole has been under attack for years, but so far it remains in the law to date. Right. I think I skipped over this slide. The other advantages of using C-Corp, right? The C-Corp, if you're using C-Corp status, then employer-provided health insurance is a deductible expense to the corporation and not taxable to employees. And employer can provide up to $50,000 in group term life insurance, as well as other tax-deductible fringe benefits to employees tax-free. However, owners of pass-through entities generally cannot receive such benefits on a tax-free basis. So the last page of our slide give an example of the evolution of a business. So Margot starts her consulting business as a sole proprietorship. She may choose to put the business into an LLC to protect herself from contract and other tort liabilities. Margot's business grows and expands its business services. She approaches other individuals to join her. They may invest capital and provide services to the consulting businesses in exchange for equity. The consulting business then becomes a multi-owner pass-through LLC. So pass-through entities can generate losses, which can be used to offset other income of Margot and the other owners. So these owners' distributive share of losses from the LLC can be used to offset their income, subject to certain limitations. And eventually, the business and its capital requirements become so large that Margot and the other owners decide to shift into the corporate form so that they can recruit capital in the private placement of securities from a limited number of investors who are not active in the consulting business. This would include non-US investors and tax-exempt investors. After the business grows larger and more successful, Margot, the founder, and the other owners decide to go to public or be acquired by a larger company in a tax-free transaction and live the American dream. That's an example that covers an evolution of business from the start to the end, starting from a sole proprietorship, then LLC to protect certain liabilities, and then to partnerships by approaching other partners who might be interested in providing consulting services with Margot. And then as the business grows and it shifts into the corporate form to recruit capital and then acquired by a larger company in a tax-free transaction. So that sums up our presentation, part one.
Right under the cap. Well done, Gwen. So I would say we had quite a few questions that were more sort of technical questions that I think we'll get into a little bit more in part two. Some of these questions I think I will be able to answer myself as well, just about sort of what's the best type of business for this versus that. And so what I'll do is I'll take on the task of answering some of those, but so that we can be respectful of folks' time, I just want to say thanks to both to Gwen and to David for giving us all this fantastic information. thanks to Mike in a supportive role, even though you guys didn't get a chance to hear from him. As I mentioned in the chat, folks who are interested in listening to a recording of this, we will send out a survey after the webinar, and you'll be able to fill out information on the great performance of the folks that you've heard from today, as well as a link to then be able to get information about both the recording and then also to be able to share that with any colleagues. You can go to our resource page at www.lawhelp.org/DC/CED for more information. Again, Gwen, David, Mike, thank you so much. Thanks to Dechert and to our friends at the Office of Tax and Revenue. We will see you again at the same time on February 24th. Thank you so much. Have a wonderful day.